Okay, I'm going to start off by asking a question. How do leaders know if they're actually growing their business or not? How do they know that they're staying ahead of the game or falling behind their competitors? Well, that's what I came up with 5 fundamental strategic growth questions to ask. As most of you know that know me well, I am big time into growth. I believe in growth. I think there's opportunities out there to grow any kind of company. It's just whether or not you approach it with the right focus, so to speak. So let me get into these 5 questions. First, just to introduce myself again, I'm Voss Graham. I'm a successful entrepreneur for the last 36 years with over 50 years of business experience. And my goal now is to leave something behind. I'm sharing what I know with younger leaders and entrepreneurs so that they can grow their businesses as even better than what I did and better than um, their competition. So let's start off with these 5 questions. The first one really gets to the core of the matter is how fast should the growth rate be to meet the goals? All right, so you've had a meeting, you've had an offsite, and you figured out that you need to grow to a certain size business. Well, how do you know that's the right growth rate? I mean, how do you know? I mean, really, in some cases, we're not doing the things that will allow that growth to actually happen. So first off, you have to check the percentages of growth. Are they ahead of the industry average by a significant amount, or are they just the standard operating procedure, which kind of gets you into a comfort zone, status quo? Economy goes up, you go up. If the economy goes down, you go down. Whereas the companies that focus on growth with a different mindset allow for, well, they hyper grow higher than some percentage above or above the industry average, and they track that. But here's the other thing: on a daily, weekly, monthly, quarterly basis, how do you know that you're on target to hit those goals if you're not tracking it and questioning that particular number? So you got to have a dialogue with the sales and marketing team and the people who are leading those teams to find out exactly what they're doing in order to achieve the goals that you have stated to the organization. In some cases, the sales and marketing are not aligned with the goals. Therefore, what they're doing is not going to drive the growth rates that you need. In fact, in often we find that they're actually holding the company back because they're using antiquated systems or methodologies or targets, or just totally mismatching. And this is the worst part: mismatching the marketing themes that are being put out there and how the salespeople are actually positioning the products within your own markets. So that's the first thing. Have a dialogue, find out what growth rate should be, and are you exceeding it? Are you on target to hit the goals at the end of the year? The second question: in your existing markets, what is your share of the market? Now, this seems like a trivial matter in most cases, but what we've discovered is that it's extremely important if you want to know how to dominate your market. Now, first off, speaking of domination, what's interesting is the research shows that you don't have to be 75, 80% of the market to dominate it. Actually, it's a much lower percentage than we ever dreamed. It's only 41.7%. If you dominate your product or your market, your regional areas, whatever you're using as the market share guide, if you're commanding 41.7% of the market, you are in a dominant position Now, what that means is that you will actually grow faster exponentially than your competitors because you own the dominant position. You have a brand. You're established as far as the brand, top of mind awareness. People want to buy from you. Word of mouth says we buy from this guy, so they attract their friends, their associates. There are people who respect them will go buy from wherever they're buying. Now, another factor, that's the first thing. You got to know that if you're at 41.7% of the market share, whichever market you designate, then you're dominant. And that's the position you really truly want to be in, because then you're maximizing both growth rates and profitability. You're still kind of in the lower section, so you're able to do that. When you make new offers, you can get the margins that you want. Now, the second part is that if you control 73.9% of the market, now you've got an issue. You've got a problem, because to grow the company from that point on, it's a term we learned in economics back in college. It's called the law of diminishing returns. And what happens in that scenario is that you have to expend greater efforts to penetrate additional markets, to make additional sales. You have now gotten to the point where you're competing with specialty items that are actually usually better suited for the marketplace than what you're offering. So you wind up lowering your profit margins, or it's a much more difficult acquisition cost for that particular business, which then defeats the purpose of optimizing growth rates and profitability. So just recognize, if you're at 73.9%, you need to start looking for another market to add on, or to break out a new product line to and use this domination that you have. It's actually, at that point, you're a monopoly of the market anyway. So not a whole lot of companies get there, but when they do, that's the problem they have. They cannot grow any faster or further without having to steal it from somebody else that decreases their margins. All right, the third question is, how stable is the growth in your core markets? Now, here's where you have to engage the customers. You need to have some customer satisfaction and customer loyalty surveys. A little marketing research never hurts. And that way you can discover how loyal they are. Another factor that you could look at to answer this question is, do you have long-term contracts, or is everything based on short-term bid basis? Long-term contracts stabilize the business, and it stabilizes your core markets to where you've got X amount of dollars coming in the building at the beginning of the month, no matter what's going on, because you have long-term contracts. Now, in certain industries and professions now, a lot of them have moved over to the Netflix, or the what do they call it, continuity pricing, where there's a monthly fee. And I know that even computer companies have done that. They've gone to licensing and fees that are monthly or yearly, and they also have these things called maintenance fees, which is basically the same process, that they're capturing more and more revenue that's consistent and very seldom drops off or slows down. It's the same level. So anything that's sold above that is, as we say down in South Louisiana, is lagniappe. All right, so that's one thing to look at. What is the percentage of your business that's tied up in long-term contracts, and what percentage is on short-term bid basis? The short-term bid basis, I guarantee you, will be less profitable in most cases than a long-term contract, because you're constantly having to sell. Your acquisition costs are up. You're bidding against competitors. It's almost well, it's hard to call it a win-win. It's more of a lose-lose. Everybody's losing because the prices are going down. The margins are getting tighter. And there's only one way to counter that, and that is to have the most awesome, effective operations group, manufacturing group pricing in that area as possible, so that you can constantly lower your cost, which allows you to compete at a lower price, but never ever try to be the dominant low price folks, because that just, I'm sorry, it just doesn't work profitability wise for the most part, unless you have unbelievable velocity traveling through the inventory turns. So number 4 is based upon your product life cycle, what level of cash flow should be available to fund additional opportunities. Now, those of you who are college grads and went through business school, I'm sure you know what an S curve is, but it is basically a giant S. It's laid on its side, and you track where the product is. And so in the beginning, it's costing more. So it dips below the break-even point. It's got a great idea, great opportunity. So you kick it off and you get started, and then the losses come in because it's, there's no market penetration at that time. You have to spend a lot of money in order to build momentum and start to drive up the backbone of the S. Now, the lower you are on that product life cycle curve, the more growth is available to you in the front moving forward. I mean, you can grow. Your profitability is going to be strong because you can charge greater fees because the market is not saturated. In fact, you're still the new kid on the block, and you're driving more and more sales as you grow that product life cycle. Now, at some point, it starts getting closer to the top. When it gets to the top and it bridges over the top, now you have maximized your ability to optimize. It becomes a cash cow, and cash flow is incredibly strong because you've got so many existing customers. Your market share, your product has been in the market and is well known, established, and there's a lot of people buying it. There's no tire kickers out there. Everyone is getting into the play now. But then notice the S kicks in again, and it starts to diminish down the backside. And that's where it gets highly competitive, lower pricing. You basically commoditize the product at that point, and the ability to make good profits is greatly deteriorating. Now, this is important for you to know. Where are you located on the product life cycle? Because here's the key: if you're higher up on the S curve, that should be supplying you with plenty of cash to fund new opportunities. If you're not on the upper side, you will not have the cash because you're having to invest your cash to get the momentum going when you're at the bottom of the S curve. So whenever you begin to move up that curve, and you should be tracking as far as percentage of business and that sort of thing, and growth rates for products and that sort of thing. Now you can begin to calculate strategically when to offer something new, which should happen on the upside. As it moves up the scale, you should take those funds and begin your research, because your S curve, remember, you're going to suck up a lot of cash as you start the new opportunity, the new product. Yet that's how the best companies operate. They use the cash flow from the older product to fund the new venture, and that way they stay whole as they grow their organization and becomes more and more stable over time. And then now we've got the 5th question that you need to ask if you're the leader of the company, and that is, where are the new opportunities in their existing markets? Now, this is an interesting question, And it is, in my opinion, it is totally driven or totally related to how well you understand your major business concept. Major business concept is what's driving your business. It's assigning the appropriate strategy that you must engage, and as well as areas of excellence that will allow you to dominate your market. If you don't know what those are and you don't have the discipline to be strict in the application of this is our major business concept, we will not, we're going to focus on that one. So focus and clarity allows you to narrow the field of play and move forward. If you're all over the place and you're trying to be everything for everybody, well, that's a loser's game in the long run. You will fail miserably. You'll just be an also ran. And I'm sorry to be so blunt, but that's exactly what I have seen. It kind of hampered my business for a while because I realized I was trying to be all things to all people, and that doesn't work. I had to specialize. I had to begin to pick a market or pick the thing that makes us unique, which I've done. And that's what's important as a leader. You've got to think about these things from a strategic point of view if you're going to grow successfully long term and maintain that growth above the industry averages. And the major business concept is a key component. It was also proven in research by a book that came out, and I'm sorry, I can't remember the name of the authors, but it was The Discipline of Market Leaders, and that correlated perfectly with the major business concept. And they were able to take it showed that the discipline that the leaders had to maintain just that. I mean, whatever that was for that company, that's what allowed them to be successful long term and stay in business and grow their business. If they ventured out and tried to do multiple business concepts under the same roof, didn't work. They had a problem. Now, there is an exception to that, and that is if you have unique business operating units, then each business unit should have its own business concept, major business concept. If they have that, then make those decisions regarding that business unit based upon that and not some global approach for all the business units, because that will be a recipe for disaster in most cases. At least that's what I've found in working with companies and developing the major business concepts for them and with them. So anyway, I just wanted to make a note that if you're interested in anything that I just discussed, I would love for you to go to callvoss.com. Again, that's callvoss, V as in Victor, OSS.com. And you go there, and there's a kind of a background information survey or quiz, whatever, questionnaire, and then that leads to a automated scheduling system. We'll schedule a call and we'll talk. The survey allows me to get some background information so I don't come in totally cold turkey, and can help you very quickly in knowing what the issues are. So anyway, I appreciate it. Again, callvoss.com, and we can have a little dialogue about you, not me. No selling. It's just basically a dialogue about your issues and how you can close that gap fast. All right. Thank you very much. Have a great day.